Welcome to today's live, guys. Basically, the title of this webinar is Top in Indices in Europe. How will that affect price of Bitcoin? My name is Yann Allemann. I'm joined by Willy Woo and Henrik Zeberg. But before we start, I just wanted to give a quick disclaimer. Any of the information that you get in this webinar does not constitute any financial advice. Everything discussed reflects only our personal opinions on the topic at hand. Always conduct your own research and consult a professional before making any financial decisions. Participation is voluntary, and the information provided is intended for educational and discussion purposes only. Without any further ado, what do you guys think?
Yeah, I think we should start out maybe by just looking at the title that we have chosen, up in the European markets. And I think I want to say a few things on that because I think it's what often goes wrong when we have macroeconomists and analysts analyzing markets is that they kind of forget about, or are not aware of the sequencing that there is in the markets when it comes to, first of all, when you see various indices top out. Normally, I mean, it's always indications or something we've seen in the history, and also how it works when it comes to the U.S. economy. And if we look to the economy, first of all, to the U.S. economy, we for a long time have said, you have a slowdown. And I stay with that, and we stick to that. And I think it's something that is actually being pushed in the background now. Now we have all this talk about the Middle East and Iran and the oil price spike, and it's taking center stage all over, which it shouldn't, because when it comes to these supply shocks, they are not changing the direction of the economy. So if the economy was in a good state and was heading higher, like what we saw in 2003 when we had the .com, you had the invasion of Iraq in March of 2003, you would see actually the markets were doing fine. And that was about oil as well. And it was same was the situation in 1991. It was also about oil. You had oil spike and so on. So people try to think that, okay, now we have an oil spike and that's all bad. And that's why the economy is going to turn. And then when there's going to be a resolution of some kind, people, turn and say, now everything is fine. I think that is like the magician here standing and, showing something with one hand, and the real act is really what he does with the other hand. Because the real economy is what tells us the direction of the economy and of the market also. And when we look to that, it's actually very simple. There's one thing we can look to. That's the ability of the economy to create jobs. The U.S. non-farm payrolls. Don't look at it on a month-by-month basis, because like in everything else, when it comes to the economy, there will be volatility, or there'll be moves up and down that that will be explained in a certain manner every time we see it. But in the long time frame, when we look at an average basis, you can actually see that there is a very nice cyclicality to see how nobody is actually just talking about this. But I mean, it's such a simple chart. It's not like I'm a genius here, just putting up a non-farm payrolls, 12-month moving average, and looking at it and saying, which way is the economy heading? It is heading down. And it doesn't. This was before the oil price. This was before Trump's tariffs and whatever we have. This is about the real economy, and it's heading lower. And the reason for that, that's another story for another day, why we see the business cycles are actually working, but that's where we have the business cycle. But this is telling us that the economy is slowing. And we are actually right now even lower than we were the last time we talked on the monthly average level. And we are now lower, going all the way back to the 70s. And there might be a good reason, and people say, yeah, but Henrik, that's because of AI, and AI is going to be taking over. But guess what? The largest component in GDP is private consumption. And last I checked, AI is not consuming. So you might have the capacity is being increased by businesses, but it doesn't mean that you have people actually going out and spending money. That is why AI cannot, and actually can only make it worse. Because if you're a business now and you want to hire in 2 people, you're probably going to say, hey, I will only take 1 because AI will make sure that I cover for the other half or the other one. So AI is not going to help. AI is going to make it worse on a short-term basis. And we can just look to another thing also. I mean, again, tell me how this is not something that is all over. I've got to move us guys here somewhere else. But why don't we hear about how we see the average weeks of unemployment is actually moving up and it's actually accelerating to the upside? We're now at 26 weeks, which is much higher going into the financial crisis. We were at 16 weeks back then, or 15, 16 weeks at that level at that time. We are more than 50% higher. That is a structural problem for the US, and not just for the US, because the similar thing we see in other countries as well. But this is actually people that are becoming more and more disconnected to the US, to the labor market, which is a very bad thing, because then you'll have a larger amount of people not being able to support themselves. And this is what we see if you look into the consumer and seeing that people living paycheck to paycheck are actually not in a very good, actually that's the highest level that we have seen, even going into the 1929 crisis and also into 2008. So why don't we have a recession at this point is what I have asked myself. And I think it's all because you're seeing that the financial conditions so far are still okay. We haven't had the moment where credit is starting to crunch, which it normally does into the final phase when consumers can't spend. All of this is all good and fine. That leaves the door open for the blow-off top. And I think we're actually seeing the markets are actually starting to react very nicely here. And I put a chart up on X also today on the small caps. But I think, and this is back to the sequencing of things, and this is where we come. If I can only find my charts again, let's take a few charts out. And let's look at the Euro Stoxx 50 index, so the largest 50 stocks in the European market. There is a certain way of identifying tops, and that is very often when you have three tops on a weekly chart in the RSI, that very often, especially when you have a rising wedge like what you have here, with a blowout or blow off here, gives you the exact top. And especially also when you look at the length of wave one applied from here to the second wave bottom, gives you a 127. That is very often when it's outside of the triangle where you have a top. I think this was the top in this index. I think this was the top in the Italian index, the MIB. If you look to what we had back in 2007 here, you actually had the similar kind of, and I use momentum a lot because momentum gives away what is coming. Because before you start to see the real action in price, you're going to see it coming into the momentum. There's a waning momentum, a weakening of the momentum. That's what we saw here. We saw momentum was high, came down, and then we had kind of the last spike in here, which was the top. Now, also due to the Fibonacci levels and so on, I had a target up here, and it actually hit that, and we have now something similar to what we saw here. I think there's at least, I'm not saying 100%, but I'm saying there's a very, very good chance that this was the top in the Italian market, and a very big one, comparable to what we saw here. If I look to the OMX, the Swedish index, similar story. We have a rising wedge, we have a divergence, we had a spike into the 127, which is very often where we see the top, and we had a move into the structure again. This has been my target for a long time. Not 100%. There's nothing like 100%, but I'm just saying it is possible. Then we have to think, okay, but why then a blow-off top in the stock market? Well, because what happens in the final phase is always that the good old US, strongest economy in the world, we have the largest companies also there in the world, always sees this capital rotation of the capital coming from the European markets and elsewhere and moving into the US. That happened in 2007. So when we saw that top in 2007, which we did in July of 2007, then we had a 15% move in this S&P, and we had a 30% move when it comes to the NASDAQ in from actually August onwards. What set it off back then? Was that a rate cut right there? No, it was not. It was the anticipation of a rate cut, which then came in September, a month later. We also could see back then, we had a divergence on the S&P here going into that top. You see the three tops, 1, 2, and 3, and that was the top. On the DAX, we had a smaller one, and that gave it away. If you look to what it looks like today, this is the DAX today. There we also had this, 2 tops only, and we had this, what I call the top in here in January. But we also have, what we look at here, the divergence with the S&P. And I don't count this as 1 and 2 because this is part of the same, but this is 1, 2, and I'm saying you're going to see this rather strong rally now. Why? Because of the capital rotation. Because people will then say, oh, we've seen the Kospi going up like this, the BovSpa in Brazil going up like that. And you start to see that there is a rotation from these areas and say, oh, we better take some money off there and put it into the US because that's what you see into the final phase. And especially when the economy is not really rolling over. So I think what I see is that you're going to see a lot of capital rotation into the US. And when it's in the US, you're going to see it into more and more riskier assets right into the top, because that is very often what we see. Because of the move in some of these stocks that we can see, you'll see that there are there's a tendency for people to move into to more riskier assets at the end of it. So what I see here is we are getting close to I think there is a potential, a good reason or a good chance that we have seen the top in the European markets, but I actually think that can be the driver of what will be the final move in the S&P and the Nasdaq. And I say this right here at a point where we see a lot of people being very, very bearish the stock market. I actually think it's going to take off in a very strong manner.
So you're basically, to summarize the point, you think that we're going to get one convergence, let's say a convergence back into US equities with liquidity being pulled from emerging markets, right? APAC, LATAM, so on and so forth, right? That's basically what you're saying.
Not necessarily only emerging markets. I mean, I wouldn't call Germany or Denmark or Sweden and so on emerging, but I think it's about that you see that final rotation from other markets into the US. Actually, sometimes you could see, and you saw that in 2007 and 8 as well. I think the Nifty, for instance, Jan, it actually topped out in I don't know if there's any Indians here, but I think it's topped out in January. So sometimes you can actually see that is that they actually hold out for longer. But there is a tendency to see that the European markets often top out into these very big tops a few months, 3 months, 4 months before we see it in the US.
And that would also probably lead that rotation of capital would also, as a consequence, ignite a stronger rally and potential move in the DXY, right? So in dollars, basically. Dollar terms. So as dollar assets or dollar denominated assets appreciate, you would probably have a positive impact in dollars relative to other assets, right? So kind of a reappreciation of the dollar, most likely.
At least that is a possibility, yes. We could see that, and that could still be a positive. We could see the beginning of a dollar rally. There, I think actually there's a chance we'll see somewhat of a pullback here first, but let's see about it. But yes, we could see a rally in the DXY, or the beginning of what will be a much, much bigger rally before we see that, because of what you just mentioned there. Yeah,
sounds good. And how do you see this linking back to, let's say, the very risk on part of the spectrum, which I would argue is represented very well by Bitcoin, Ethereum, and let's say the rest of the alts? Like, how do you see that playing into this?
But I think that I think we are, of course, we need to see people being very, very frightened, or what do you call it, fearful about the situation before we actually see a real bottom. And I think there's a good chance that we have seen that now. Here's this is the Russell 2000, the small caps. As I see this is a very bullish setup. So, and I would just relate that to what we potentially then could see also in Bitcoin. I would leave that to you guys also. But I think there's a good chance that we could see this kind of risk on rally in the small caps, like what I see here. Then you would see that you could see a good strong move in Bitcoin and in Ethereum and so on. And I expect Bitcoin to have a good strong bounce. I still say, this rotation and everything is going to bring it up to 110 to 120,000 as a minimum. That could be, I have two scenarios, but this is my main scenario. And I think Ethereum still has a very strong rally ahead of it.
Yeah, I mean, there is an argument to be made if you look at kind of broad-based macro with its kind of, let's say, constituents of assets that you look at, right? From kind of gold on the far left as kind of more safety type place, all the way to the Russell, and Bitcoin as kind of the more growth oriented place that you can have. We have seen an inflection, I would say, probably since the later parts of February, early parts of March, coincidentally with the, let's say, the start of the Iran kind of war. We've seen a reinflection, right? So there's been a slightly more aggressive risk positioning since that rotation, and then we haven't seen signs yet of that subsiding anytime soon. So I think I am seeing, at least in terms of the kind of the constituents of our framework, they are kind of indicating that as well, which is interesting. Now, this does not guarantee any follow through, but it does mean that we have seen an inflection point, right? If you look at January, February, in terms of how investors have been deploying capital, we have seen massive dispersion. So dispersion is basically the amount of diversification that you see within equities, right? So to look at equities specifically, and we've actually seen correlations between equities, especially when you look at Russell 2000, go down. And usually when you start seeing the extremes of that, so very large dispersion and very low correlation, you start seeing the initial parts of an inflection or rotation back into the majors, right? So Nasdaq, in this case, taking the lead, but also S&P and the Russell 2000 as an actual index, right? So the actual index starts driving the narrative again, and not the actual, let's say, the compositions of the index, which is what we have been seeing in the later parts of January and pretty much the entirety of February.
Right.
When it comes to liquidity, Willy, how are you seeing it from a liquidity perspective, more on the fundamental side of the equation?
Yeah. Okay. Well, share a screen.
You weren't super convinced the last time either, so I'm assuming things haven't
I haven't
changed.
been convinced on a rally on Bitcoin for 6 months now, I think.
Well, it won't be a fundamental rally, right? I think we always have to differentiate between a fundamentals-led rally and a rally that is actually led by just equities beta, right? Specifically Nasdaq. But yeah, how are you seeing things?
Lights out, Willy?
Lights out. It's symbolic. I think he's
all right.
alluding to the doom of Bitcoin, I guess.
But why don't you give your 10 seconds on that, Jan? What do you see by now, also liquidity-wise, until we get Willy back on?
I mean, there's definitely some improvement across the board. What we're seeing, and I'll go into that a little bit after with Hawkeye, but we're seeing a relative decoupling between Ethereum and Bitcoin, where Ethereum has relative strength versus Bitcoin. There's no doubt about this. At the same time, I think, like we see in most kind of rallies into the climax, or into the kind of final blow off top, as you would say, is that it's not fundamentally driven. Like fundamentals don't support blow off tops. It's just reality, right? They get formed into waning RSI, waning momentum on a more structural multi-quarter type perspective, right? So it's consistent with what you have seen in the past, and I think it's also consistent with why people tend to miss the final blow off tops, right? Because they aren't logical in the true sense of the word, right? Where flows fundamentals aren't really backing what you're seeing with price, right? It becomes irrational, basically.
Exactly. I think that's the very, very reason why people are sometimes find it hard to believe. I mean, the more you analyze, actually, the more you are into your stuff, you can actually think and say, this can go on. And then you just see it. And that's where it's psychology more than it's actually, as you say, market fundamentals that takes over. So I completely see that. And you can see it also when at least I see it when I tweeted on X, there's nobody believing that you're going to see this here. And that actually, from a psychological perspective, you can see that is going to bring, when you then see it, and after it's been rallying for 15%, 20% on the Nasdaq, a lot of people think, oh, but we were wrong then, and now it's just keep going higher, and that's why we have to start turn bullish. So it'll be very, very difficult for people to navigate in that situation when it starts to move higher.
Yeah,
Willy,
absolutely.
are you with us?
Yeah, it's Willy back. All right.
We have had we're in the middle of a storm, and I don't know, the power glitched out and the Wi-Fi is down, so I've retethered because the Wi-Fi will take a bit to come back on.
That's good.
I'll share a screen again. Sorry about that.
That's all good.
We actually have Tesla Powerwall, but they haven't finished installing it, so they should have protected us from that. But anyway, let me get back to my chart. Right. So, there's a lot of, I guess, permabills that are saying that the bottom's in, because we dropped down into the mid-60s, into this support range here. And there's a lot of long-ranging indicators that are saying we're quite close to a bottom. This is my fundamental over the cycle, this risk model, which is really measuring the liquidity dynamics that are entering Bitcoin or exiting relative to its momentum and price behavior. And certainly there's no significant liquidity here to call a bottom, because bottoms are relatively easy, I would say, to call. Tops are very, very hard. Tops are like run by momentums after the fundamentals have dropped away. And you tend to get, volatility coming in, and it's a bit of a crapshoot. You're just like going higher and you don't know when exactly it drops. But we're in a bear market, and a bear market is the absence of liquidity, and the asset is starting to free fall back down to where the where to a point where liquidity comes in. And in the vacuum of liquidity, when it does come in, you'll see it immediately. And Bitcoin will feel it. And what we'll see in this indicator here is that comparison between the price and the liquidity will start to drop the risk down, and it will stay in a low region here. We're not there. We're still in the high region. We're still in the bear market. It dropped here, it dropped here, and here, and it's never dropped and stayed low. And of course, this is the point where liquidity started to drop away and went into the high risk region. And so you do see price run up in the high risk zone. We know that the days for the bear market starts to tick down, and we topped obviously on October the 6th. Now, if we look, we can actually look at the sort of more of a microstructure here, and you can see that we're kind of ascending triangle. Risk is still quite high here, and we need this to hover low. And the latest print here, it's not breaking any new lows. It's actually climbing up a bit. And in a bear market, you do see these dips. You do see risk drop because there's a little bit of liquidity coming in. And that's what's really happening is when a bear market hits, you get sort of fast moves down, liquidation driven, and then it overextends, and we're very heavily overextended, and that creates kind of a weight in this train heading down to Hades. It gets ahead of schedule. We have to wait a bit. So people are saying, "Oh no, look, Bitcoin's outperforming gold." Well, it's just because gold was overbought. Bitcoin's oversold. It's got a rubber band back up to its rate of decline. It doesn't mean that we're out of a bear market. It doesn't mean that there's any geopolitics involved. That's just narrative. Overall, we were way oversold, and you can see visually that it takes weeks and weeks, months and months for us to kind of sideways consolidate out of that oversold position before it's ready for its next move. If we were to look at this and take apart the liquidity profiles of spot investors and what's happening in futures market, bearing in mind futures is quite wild because this is more of a short-term hold. It gives you a fuller picture. And what's happening here, if you can see it, is we're leveling out in the spot. So the liquidity is stopped its rate of drop by spot investors. Meanwhile, paper liquidity is staying across bullish. So that's kind of a good sign. It means that there's a bit of life in this plateau here, particularly if the paper liquidity starts to really ramp up. Last time we saw a really good pump in paper was here, right? July 2021, that did second top before the true bear market came in. Now, Henrik saying we may at the lower bound 110, 120. You need to see this climb significantly. The stage is set because the spot here is going quite neutral. But I'm not a big believer in that thesis. I think it's premature. I need to see that paper liquidity really crank up here. I think in terms of timing in this bear market, we are more in this zone here. We've had our lower high in the paper pump, and that was absolute top. So same here. And then we're in this local sort of like zone here where we're getting that's that. And if I was to zoom in even close to the sheer liquidity, you can see it again. We had a liquidation drive and a complete collapse of liquidity. See us going into the orange red here. That's negative capital. That's like capital leaving Bitcoin at a decent clip. Okay, and we had a bottom of that. So the rate of liquidity started to slow stop and actually reduce here. And I called local bottom here based on this liquidity. It usually leads by a number of weeks. And so that was in February, and in March, price responded by moving upwards. I'm not seeing this as a healthy structure. A healthy structure is if this is climbing straight up here and it rolls over, up here or here, and you've got here, it's going neutral, right? It's actually in a no man's land. And so I see the structure right now as a sideways pause in our bear market. I think 85, the mid 80s, this line here, which is the cost basis of the short-term holders, around, where is it right now? It's 84,000 and dropping. So I think in the mid 80s, 80 to 85 is kind of a very strong resistance. If we can contest that and move higher, and you see a liquidity picture climb, then we could go higher. And if this liquidity picture starts climbing again, remember it'll take a while for that to follow through because the price doesn't move quickly these days. It's a bigger shift. So most likely for Bitcoin, which we have almost X-ray vision into its liquidity because of its blockchain and just the sheer amount of exchange data we can collect on it, it's not really looking that sharp. I think we'll consolidate into the zone. We might reject in the 80s, low 80s, mid 80s. And then I think we have a continuation, because I certainly don't see this long-term structure coming into the full reset phase. Typically, liquidity drops much lower, right, down into here, spot liquidity. And so I think we've still got most of the year to run on this bear market. I feel like it's just very similar to the last bear market in terms of timing. It'll take a year at least. And if we were going to look for a pump, we already had it. It was this one. This was the dead cat, which wasn't powered by the fundamentals. Spot was falling away. We had a paper pump and we got a higher price. It was very similar to the last one. In terms of timing relative to fundamental, TradFi, look, we topped in October, and you can see on the right panel, that's where it is here. All right. And if this was the top in equities and we don't get a blow-off top, which is being, theorized by Henrik, if this was actually the top, it would fit the normal pattern. January, 2 months later after the Bitcoin top, would fit the pattern. Typically, what you see is that the last top was here in November, okay? And the top on the S&P was January, 2 months later. And that's a proper typical lead lag relationship, because the S&P is like, was it 40 trillion, some very big super tanker. Once smart money pulls out of Bitcoin, it's felt immediately. When smart money pulls out of S&P, all the indices still allocate. They're not pulling out a lot before the liquidity void starts to be felt. It's different on a bottom. On a bottom, they both kind of climb out of it very quickly. And in fact, the S&P led, because in an absence of liquidity, when it comes in, it moves price very, very quickly. So that's the dynamic. And so I think timing-wise, and it was timing that led that got this market and called the Bitcoin top. The timing-wise, it would fit that we've actually topped in S&P. But of course, I don't have X-ray vision on the liquidity dynamics in the S&P because we don't have a blockchain on it. So, but just in terms of the lead lag relationship with Bitcoin and time-wise, it would fit if we've actually topped, and we're breaking down now. And we would be entering the second phase of the bear market. I'd like to say the first is we're Bitcoin bearish. S&P hasn't yet. There's usually 2 months, and then there's a little bit longer before we get a confirmation on a bear market on S&P. That would have been here in the last bear market, where it rejected a higher high, had a lower high, meaning a downtrend. And that would have been the start of the middle of the bear market. So around about here was the start of the middle of the bear market. I feel like if this level breaks down here and goes lower, I think that would be phase 2 of the bear market. And like the final phase is actually the bottoming phase, where volatility is starting to drop. It's around this zone here, and you start to see liquidity starting to stabilize. So for me, there's not much to do other than patience, and not get too much hope in. Yeah, just wait it out. The bottoms take time to form. We'll see the liquidity stabilize. We'll see it start to uptick, and that would be weeks and weeks, potentially months, before you see a bottom. And then you usually get an accumulation bottom in Bitcoin, which is here, which lasted 2 months or so. But the accumulation bottoms here, November through to March, that was a 4-month accumulation bottom in the last cycle here. I mean, 2 cycles back, and this cycle was nuts. It took a good part of 10 months in an accumulation bottom. So I do expect a sideways. Liquidity comes in, puts a floor on price. The last of the sellers come in. You'd want to see a final capitulation, and that's sold right into the floor, where there's near infinite bids at that price. That'll just create a sideways pattern. So that's what we're looking for. I'm not seeing it now. Liquidity is far too weak for this to be a floor. We haven't seen a capitulation. That doesn't look like a full capitulation, because it's too early into the bear market. So I'm looking tail end of this year for a floor. I'm looking first quarter next year, accumulation. And we probably don't know about the next bull market until the second quarter of 2027. Plenty of time to run. So that's my view.
Yeah, that makes sense. I think we all agree
May I
on,
ask
yeah,
one thing?
we all agree on, yeah, go ahead.
What if we are in a bear market in Bitcoin, but the bounce, because you can be right that we are in a bear market, but the bounce can take us up to the 110, 20, as I say, just like what we saw in 21.
Exactly.
Because I actually see a lot of similarities to what we saw in 21. The top in 22 was, from a technical perspective, Elliott waves, not really the top. I know that might sound a little difficult to understand, but if you look to it, the situation you had in 21, we actually had which was not supported so much by liquidity, but you had a new top. That is the kind of move that I could see could actually help us to propel Bitcoin up to the 110, 120. I was just looking also to your chart there. How do you see that?
Yeah, it's a good question. I kind of covered a bit of it.
Mm-hmm.
And it really comes down to this chart structure, which is really looking for this bullish crossover in paper liquidity. And we've got the spot investors holding strong here, not bullish yet. But if you look at the make, it actually spot was stable, and in some ways a little bit bullish, which when it went bullish, it actually opened the door. When both spot and paper go bullish, you usually get a run. So it's currently at stabilized. If it runs up a little bit and this crosses over bullish, that would be great. But remember, this scenario here was predicated not only by the liquidity dynamics here, but it was predicated by equities. Now, if your thesis on equities going strong plays out, that would be necessary, because if you look at here, this run up here was actually like, it looked bearish, but equities hadn't rolled over yet. And you can see it here. This was where I'm pointing to. Equities were still running up higher, right?
You had a 50% move. You had a 50% move into that top around there. And the one thing I would say, which I would have to challenge your thesis on, is that if you're right, then the Nasdaq has been the first index almost across the globe top out, which topped in October of last year. And I find it very, very, very hard to understand how we would into a technical top like what we see here, which is a techie top, or tech bubble, or whatever we should call it, that we actually will see the strongest, the generals actually be the ones that are falling first. So that's the only way I say, if you were in a situation where October was the high in the Nasdaq, then I will also challenge and say, wouldn't we have been in a recession at this point if we are in such a big bear market as we potentially should be? And that is just a little far out for me to say that if we are looking at a situation where the Nasdaq topped in October and we are not in a recession at this point, because we can look to the initial claims, we can look to the short-term yields, we can look to the yield spread, we can look to a lot of things. And so I just find it difficult to see, why would the Nasdaq be the first index to top out and not? And again, remember, we had the same situation in 2024. Well, or 25 actually, when we had the bottom in April. Everybody was calling for that we were in a bear market. BlackRock was coming out, CEO saying we're in a recession, which was nonsense. Because
does the Nasdaq lead? Does the Nasdaq usually lead the S&P into the bear market?
Could I show something that actually proves that point, Henrik?
Let me just say, but why would you find it? What you saw, Willy, back in 2007 was that the Nasdaq topped on October 29th or 31st, something around that time. The S&P on the 8th of October, which was 3 weeks before the Nasdaq, and you saw all European markets topping out in July. This time around, all of a sudden, that whole circle has shifted. And I just don't see that. And that's also why I say, and if you combine that with the situation also with the recession potentially, we don't have that right now, because if you had, you would see short-term yields dropping like rocks. We don't. We see them actually spiking somewhat. And that's why I think that's just one thing.
Closer, Henrik. Yeah, go ahead.
Yeah, just one thing more. And that's why I think we need to take that in and say the scenario which we had in 22, where we actually saw that extra, just one more bounce, which actually gave us a 50% move on the Nasdaq. On Bitcoin, 50% higher within a very, very limited time frame. I think that is what we could see. And you only had a 15% move in the Nasdaq into that top. Okay.
Okay. Just very quickly before we go into the questions, right? Because I think there's a lot of things to unpack here. But maybe in part to answer Willy's question, what's interesting to see if you look at the macro kind of setup that we're seeing, right? So what you're looking at here is a dashboard that tracks momentum, trend, and basically flows, so actual liquidity across about 30 different indices, right? So 30 different indices and subcomponents of basically what makes up the broader macro space, right? And what's interesting when you look at that on a unidimensional type of perspective, right, which is what you see down here, which is basically taking those 30 assets and classifying them as growth or safety, right? So things that you generally attribute to risk on or risk off type of plays. We've actually had a bottom in a risk off type of scenario back in, let's say, roughly the 28th or the 23rd of February. We've actually had a reignition of growth ever since then. That's what I was mentioning before. We've actually had if you look at it from a simple moving average type of perspective, we've had an inflection point that we have not seen since. This doesn't go back far enough, but if you actually were to go back far enough, we've seen that inflection point in September, which was actually the opposite kind of top towards bottom type of inflection. Now we're seeing a bottom towards a top type of bottom inflection point, right? So that's very, very telling, very, very important. The second thing that's very important is when you look at it from a relative lead lag type of perspective, you see very clearly that the Nasdaq, to Willy's point, is actually leading the reignition of this risk on play versus S&P growth, right? So it's even obviously much more of a pure play versus S&P growth. And it actually is leading what we're seeing in Bitcoin as well. And what's also interesting when you go deeper into this is that Bitcoin right now has a very, very high beta versus Nasdaq, okay? Which is also exactly what you would expect in a situation where fundamentals aren't necessarily driving the behavior, but they're actually being driven by a general reignition of a risk rally across risk assets, right? So not specific to Bitcoin, but it being part of a broader basket of risk on plays, okay? And what's also interesting when you look at that at face value, you basically, if you look at it here, from a flow perspective, you see taking, let's say, Bitcoin a little bit closer and putting it under the microscope, you see that it's still not strong enough. It's still coming in as a sell in a broader asset allocation type of perspective, but it is really reigniting again. So when you look at our liquid or our flow score that we look at with all the different assets that we track, right? So roughly 420 different types of sub asset classes, we actually get a increasing score. And that has not happened basically since the November into December kind of relief rally that we saw, this part here, right? So this is a very telling situation, especially as, let's say, the spread in the net capital flows versus the actual moving average is also inverting, right? So this is telling me, you see it back here as well. And you look at pure flow, you see that it's actually been bottoming for a while. So it's been bottoming in terms of the absolute flows, but it's been reigniting in terms of our actual score. So the algorithm that looks at this in a relative sense, right, is picking up an inflection point or a change in dynamics here, right? So that's something to keep in mind of. Now, obviously that's IBIT, so that's not directly on-chain liquidity in the way that Willy Woo is talking about, but this actually might be a precursor to that shift in kind of market mentality, right? I don't know, Henrik, if that kind of answers the question of the lead lag, but I think it's very interesting that flow definitely is indicating an inflection point there and is indicating that Nasdaq is leading our way through, right?
Yeah, I think it
sounds good.
Yeah, I've just pulled up the Nasdaq chart, and it typically leads S&P by a month or two.
S&P growth especially, yeah.
Yeah, so correct. Yeah, I mean it would be a normal top, like with Nasdaq rolling over first, like Bitcoin. And I think the strongest argument for me of why we won't get this large pump is just time in the cycle. And that we already had our paper pump. That pump is kind of a true cat. And usually it creates a higher high here and it looks great, but actually the fundamentals are dropping away. And so we're actually past that point. And actually is a declining in a bear market. So if that goes much higher and a higher high, then and spot liquidity stays good, maybe climbs, and this starts to rally again, then this would be creating a new pattern which we haven't seen before. And surely those three things are what I'd be looking for a rally to 120 plus. is equities going higher, including NASDAQ, spot liquidity stable or climbing, and an influx of paper liquidity. And so right now, I need to see equities to climb. Spot is sort of stable. It could climb a little bit, and that would be good. We haven't seen, it's crossing bullish. We haven't seen this run up, okay? And this would need to be a run up into this zone here.
Nasdaq needs
I've
to
never
lead, Willy. Nasdaq needs to lead. Like I think what Henrik and I are kind of getting trying to get across is we need Nasdaq to be strong. There's no doubt. So the dispersion that we've seen, kind of a low correlation environment in equities, we need to see kind of a reignition of correlation, right, back into the majors. Yeah,
I would need to see Nasdaq climb significantly here, lead S&P, but
correct.
I would expect Bitcoin to lead Nasdaq. Like you saw it here.
Not at the beginning. So in the beginning phase, it's actually Nasdaq because the capital basically concentrates back into the majors, right? So Nasdaq is the net benefactor, and as long as that is not too explosive, then Bitcoin basically takes over, right? Where at the moments where it actually doesn't take over is when Nasdaq is extremely strong and actually becomes a juggernaut, because then it actually pulls the liquidity from Bitcoin because your relative risk-adjusted returns in Nasdaq versus Nasdaq components, right? So other growth stocks is actually more attractive than trading Bitcoin. So it really depends on how strong that is. We want a strong Nasdaq, but not an overly bearing strong Nasdaq.
Yeah, it looks like Nasdaq led slightly there by a week.
Yeah, exactly. That's what we want. A slight lead so that Bitcoin can catch up and then kind of accelerate forward.
And it led S&P by another week. Yeah. So all right. Yeah. Anyway, so those three things need to be in place. So far, none of them are in place, but there's potential. There's potential, at least in the spot liquidity in Bitcoin and the futures, there's potential for that to happen. It's in the wrong time of the cycle for that to happen. It would be like having a summer's day in the middle of winter. I just would say timing has been the thing that's been correct for Bitcoin. Nobody got those targets right, but the timing indicators certainly nailed it. Here's a time indicator which I keep pulling up. These are trend exhaustion on long-term candles, the 6 monthly, and I noticed that that's fired there on the 1 year. Last time we had that was January 2000, 2000, which led to a decent bear market. So we expect it this year. If I was to look at it into like a quarterly, in actual fact, it fired this quarter. And so it'd be interesting to see.
I think we're aligned. I think Henrik and I are pretty worried about what comes after, kind of what comes on the horizon, what's showing up on the horizon, like the dark clouds forming. But I think there is now,
I mean, that's in particular
of a move, right? That there is a rebound potential here that is not insignificant.
I'd say the rebound has got like only very little time in it based on this. You know, like if we're only got a few days left in the quarter, and then this is expected to paint red. I have to go back multiple decades, maybe a century, for this to break on the 3 month, at least half a century. So if this remains true, that means that equities are going to be confirmed bearish in the next few weeks. We might get a little bounce in Bitcoin into the 80s, but then that would signify both Bitcoin and equities bearish, and that would be what I'd be looking for, is confirmation of phase 2. And also you can see that this is stoic, right, indicator and oscillator, and that's also a timing indicator, which is these are the indicators that have been working, and we've got a bearish divergence, and we really need this to bottom into a oversold region time wise. All right. So again, I'm looking out to much later this year, and maybe first, second quarter before we're really to dig out of it.
I would say this, right? So when we talk about a rebound, obviously, Henrik, correct me if I'm wrong here, but I would not expect that to go beyond May of this year, right? So we're talking the next 2 months, right? So that's within
as we saw, the margin of error. Yeah. In 21. And we saw how fast that went up. As we saw in 2007, we had 11 weeks and the NASDAQ went up 25%. And guess what? What happens into major tops is exactly that we see straight up. Look to what has happened around the world, the Kospi, the Bovspa, the Nikkei, and so on and so forth. They all went like that. But again, I find it hard to see that all of these have been outperforming the Nasdaq and not the other way around. So I think you're going to see, as I started out by saying, that this rotation we're going to see, because the rest of the world are now finding their top, or at least the European world starting to seem like we have the top in here in Europe, and they start to see that kind of rotation. You will see potentially a bounce then, but it's going to be very, very limited. And that's also why it's going to be so convincing, because try from a psychological perspective and think we get some kind of resolution, hopefully to the situation in Iran. Okay. All of a sudden, and also maybe we get some, which I also expect, inflation numbers are coming down. I don't think this oil inflation, supply inflation is going to play out a whole lot. So all of a sudden we can be in a situation where we all, inflation is not so much a problem. You don't have the situation in Iran. And then we have the new Fed chair coming in. I mean, we would expect that somebody new coming in, potentially being a little more dovish on the rate cuts, right? Or at least maybe coming in and suggesting rate cuts. All of these factors with the rotation could generate a lot of move into risk assets, into the final phase. And I think those are the ones that will be so convincing that when we sit here in 3 months' time or 2 months' time, people will say, how on earth can you be bearish in this in this environment? Because the Fed is there now with the new Fed chair. We don't have a Iran situation. And don't you look at the stock markets, because it's up 25%, which is exactly what we saw. And again, the business cycle is still rolling over nicely, and we have that potentially we see in the top in the European markets. At least that is my scenario for now. It's not going to last long. It can last everything from 8 to 15 weeks, I would say.
Given the time that we have, it'd be amazing to continue this conversation, but I think we need to kind of try to keep it within some time bounds. Do we want to go through some questions?
Yeah, let's do that.
Just to kind of maybe also summarize our points, because I do think that the last time it gave everyone a little bit more of a kind of a final perspective of where we stand, right, on the spectrum. Willy, do you want to take it away? Maybe we go through the actual Q&A.
I'm reading from the Q&A panels. I know some people are typing into the chat, but that's hard to find. All right. When do you suppose the final leg of the blow-off top begins? The market seems to be stuck in a downward trend right now. What will snap it out of the down cycle? That's really for Henrik. I think he's really covered a lot of it, but do we want to add some comments there, Henrik?
It began on this Monday, easy, on the Nasdaq.
Okay.
It began Monday, and if you look to the small caps, as I just showed you just before, it's very, very clear that it has a very bullish setup. It has a divergence.
Very strong. Small caps are very strong.
Okay. Extremely strong here.
Agree with that.
Okay, there you have it. It started. Coming to Henrik, I think there's a lot of confusion in your community regards to the Dixie. In my opinion, no risk on without a falling Dixie, also driven by re-softening oil price, to be followed by re-strengthening of the Dixie into the further weakening of the economy and potentially a flight to safety. Is this a fair summary?
Listen, we can't put it down to that. Dixie declining is bad, and rising Dixie, or the rising Dixie is bad, and the declining Dixie is good. You can't put it down to that. So if you look to it, and you look to the bottoms we have had in the Dixie over the last many years, you will actually see that there can be from everything from an 8 to a 15 weeks time of phase where you can see that the Dixie can rise, and you can still have a very bullish risk on rally. Why? Because what Yann said just before, when you start to see assets rotating back in, and we actually had sort of that situation when Trump was elected, you had a situation where liquidity was coming into the US, and you saw the Dixie rising, you saw the Bitcoin also rising. You saw that as well also in 2021. You saw the same situation there. There was a very large bottom in the Dixie, which I actually called on the day back then. I think it was on January 6th and in 21. And you would actually see that actually also was accompanied with a lot of strength in both the small caps and so on and so forth. So you can paint it up black and white. Of course, Dixie moving above 102.35, something like that, is starting to put a strain on things, because what it does is that all debt in the world, which is denominated to 60%, 65%, in US in the dollar will start to be felt more heavy. Payments and then interest rates and so on, or sorry, the interest payments on it. So it will be. There is a level where it's not so good any longer, and that will be the deflationary part. But there will be a fun phase where it's because capital is coming in, so we can paint it up. Up is bad, down is not is good. It's not as simple as that.
Okay. Just the second part of the question is to me, how to explain that capital has been potentially absorbed by rising energy markets, including higher demand for margin, and yet Bitcoin has been creeping up. Can you generally say that the Bitcoin liquidity situation has improved, or has it bottomed? I.e., the descent has stopped. Okay, on the energy side, look, Bitcoin's an energy coin. It's secured by energy, but it's pretty. If you look at how Bitcoin works, is it's quite immune to what the energy price is, because that's just the security budget. And the security budget is driven by the price of Bitcoin. It's the other way around, because whatever you're going to get out of a block reward, that's that in dollar values is actually the budget that a miner has to operate under. So if energy prices go up, they're going to spend less units of energy to secure. It's actually quite independent. It only deals with sort of local between miner competition, and also has a little bit of impact on the very short-term dynamics. Based on mining fluctuations and how much supply sometimes they dump their coins back on the market to sort of weather over a bad sort of economics. So I don't see that as being too much of a sign over the long period, only a local. In terms of liquidity's kind of gone back from deeply negative to neutral. So it's what I'm expecting is it to sit around neutral and then to break down again, because you tend to get these dips in liquidity breaking down until each breakdown becomes less severe, until that's a sign that the liquidity is starting to bottom. But yeah, currently it's quite neutral. We had our first real proper breakdown of liquidity, which was that big red part in the chart I showed you, and that's usually the sign where you confirm the bear market, which takes a few months for that confirmation. Which we got a few months ago, and was months late after our price top. So anyway, and the next question, Willy, do you believe in the 4-year cycle? Does your thesis revolve around that? I'd say you could backtrace 4 years. I think the liquidity cycle is roughly 4 years, global liquidity. Halving cycle is 4 years. The election cycle is 4 years, which arguably impacts the Fed printing cycle. So those things are objectively 4 years. You can't say they're not. In terms of Bitcoin's price being 4 years, no, I don't think it necessarily has to follow that. My thesis revolves around measuring the actual liquidity, not narrative, not news, not nothing like that. It's actually what are investors doing? Are they putting it into this coin? Are they pulling it from this coin? And just having good lens on that. So it doesn't rely on anything around anything, actually, other than what investors are actually doing. Not some theory that they will because of this news, because of this regulation, but what they are actually doing right now and what they've been doing the last backward-facing amount of time to build the current structure. Willy, sell 1/10 of Bitcoin to fix your Wi-Fi. No, I've got a Powerwall. I don't have any Bitcoin. I told you, I sold in September. We didn't have euphoria in Bitcoin this cycle, so doesn't this suggest more upside left? No, not at all. I think also the euphoria we're used to was 2017 when we had no paper markets, and we had much more euphoria last cycle, and it had around a double top. We all expected 100,000 was the consensus. And of course the paper trading changed all that, and this time we didn't have much euphoria at all again. But you can see, like, these are generalized patterns of market cycles, but they don't have to be like clockwork. If it is like clockwork, everyone be a billionaire, right? That's why markets are hard. Okay, next one. What are your thoughts about Bitcoin hitting a new all-time high before the halving? Different from what we've done in previous years. No, I don't think so. When's the next halving? Does anyone know? Trying to work it out in this chart here. It's 2028. 2028. No, I think it'll take a bit of time for it to regroup. And I think this bear market is going to be a hard one. Fully aligned with Henrik that we're heading into a decent rip in the Titanic. We're going to go down. Like even the 1 year candle reversal is like, gee, you saw that in 2000, which is the dot-com crash that led up to the world financial crisis. We saw that in 1968, Nixon shock, which led to fiat. They had to rebalance the debt and the structure of money to fix that one. And we saw it in 1929, the Great Depression. So that's what the trend reversal looks like on the technical. So I think it's going to be a big bear market, and I think that Bitcoin will follow suit. It'll be very risk off, and I think it'll take time to regroup. The 2013 to 2014, 15 bottom that was an 18-month kind of bear market. It was a very long one. Experienced that one. It was hard. I think that potentially could be in play as well if we're getting pulled down by risk off in macro, TradFi macro. What else? Are you
3,000. It's my target.
Yeah. Willie, you're forgetting about the incoming liquidity increases. Well, you can print money all you like. If it doesn't go into Bitcoin, Bitcoin doesn't go up. You see Raoul Powell's been saying, look at him too. Wow, look, it's going up. It's going to go up. Crypto is going to pump. It didn't because it didn't enter. So that's what we're measuring here is that, again, this is expectation, it's narrative. And even if it happens, you have to measure the behavior of it entering the asset class. And we never picked that up. If anything, it got weaker and weaker. And in the investor letter, we went high risk zone very early before the top, and it did top because it didn't go into the asset class. Question for Yann. Thank you for the IBIT indicators.
Very good answer
Similar
there,
to
Willy.
what's that?
Very good answer. Very, very good answer, Willy. I mean, it's not just about one factor, and people that believe in that will be crushed in this bear market. So good answer there, man.
Be careful, eh? Like you need to see a lot of confirmation and confluence and all this stuff lining up, and you need to see it happen. Well, better to be late than to be wrong and on the wrong side of it as it collapses underneath you. And when it collapses, it's hard to get out of because liquidity's not there to get out. Question for Yann. Thank you for the IBIT indicators. Similar to that, how are the indicators looking for Ether flows? Ethereum flows? No, BlackRock Ethereum. Okay, Ether. All right. Is there the trend changes? Does that signal a 3 to 5x move in coming weeks?
3 to 5x is quite a lot to ask.
That'd be nice, wouldn't it?
Yeah, that would be nice. No, I think it does definitely point to a short-term change in whatever trend that we've been on since the September highs. I don't know, Henrik, exactly when equities topped out, but it was around end of September, right? Mid-end of September of last year. So we're seeing ample evidence or proof, I think, just tracking kind of these different elements that we combine into our framework, like Willy said, right? A lot of different elements that give confluence, especially on the kind of that midterm perspective. And it is indicating that there is a change. When it comes specifically to Ethereum, there it's actually our internal strategies that are indicating that Ethereum actually does lead Bitcoin here. So it actually has relative strength versus Bitcoin. It might actually be interesting, Willy, next time to kind of compare the two versus actually incoming paper and spot flows. But yeah, there is definitely, I think, room for Ethereum to really gain some ground here, but not enough indication yet that this is the beginning of a move towards all-time highs. I think that's where I'm a step behind Henrik and maybe a step in front of where Willy is right now in terms of his thinking. So my intention is definitely shifted away from Bitcoin, and there's a lot more on Ethereum right now. Yes. If you're interested in that, definitely reach out. So for everyone that is interested in general kind of cross-asset macro, kind of general, momentum, trend, flow analysis, we can have a subsequent meeting together to go through it. So I think they sent the link somewhere for Hawkeye. So all of the stuff that we show here, at least on my side, that's all linked to Hawkeye. Next question.
Okay. Yeah, and also we have an investor letter. It's run on Substack,
Yeah.
and some of these models go into there. Actually, certainly a lot of it drives our analysis. Some of the models are published each week in there. And so the next thing we're looking for is spotting the next cycle bottom, because we got the top. So anyway, Henrik, what are your thoughts on the situation in Japan, currency devaluation rates, and now oil rising?
That's a lot of things, right? I'm gonna start somewhere else. I mean, I don't want to jump into bits and pieces of what we see there. I mean, Japan is at the end of the easing cycle. This whole experiment with printing money which they really started on in 1989 and then ramped it up in 1997 during the Asian crisis. That was when things about QE really came out first. That was Japan, the Bank of Japan, and I think that for a long time we all expected that wouldn't create any situation, and that there would just be manna falling from the sky when you've printed money. And again, we gave Bernanke a Nobel Prize on that. So I think the situation in Japan is a tricky one, because they are doomed if they don't, and they're doomed if they do, right? In terms of whatever they want to protect, they want to protect the fiscal side of the economy, or they want to protect the yen. That is a problem for them, and if they have to choose at some point, and whatever they do, it's going to be bad. So I think what we're seeing there is really that by the end of the day, that if you tried this experiment for long enough and you thought that you can just bring prosperity to an economy from printing money for such a long time, then you have a situation which will blow up in your hands. And I think that's what you're seeing. So whatever they do now can only come something bad to it. I think I'm not really sure what to think. I think that we're going to see a very bad bear market developing in Japan, in the Japanese market.
Yeah, they can basically choose between saving the national economy and basically destroying their ability to export, or the other way around. So they're either going to basically destroy their current account balance or their ability to actually tame inflation, basically, right? And actually have growth without stagflation. But yeah, it's going to be an interesting one. I'm fully with you, Henrik. It's do if you do, doomed if you don't, basically. Next question.
I think the last one is, Henrik,
Yeah.
let's entertain one scenario real quick. Let's say that a big scare from the Iran War or something related, where a big black swan capitulation occurs, almost like a COVID style crash. How would this affect your perspective then? Would anything change?
There is an assumption there that black swans, they just appear out of nowhere. And that you have, as I said before, go back in history, look to what wars have done before, look to what oil prices have done before, when it hasn't happened in an environment that was already in a recessionary recessionary environment. Black swans don't just appear. It's something we've been taught. It's actually the other way around. And there is a toxic environment that is developing. But I don't see that something coming out there. It's not like I will say, all of a sudden everything is wrong and not playing out to this, because there are simply too many things suggesting that we will go higher first. And just the very fact that we have to be down 5-6% on the NASDAQ, everybody's agreeing that we have a bear market. I mean, just go figure. That means that the majority that right now we had, was it down to 6% or something like that? That was or was it 10%? I don't know. But apparently 90% of the entire market has gotten it right this time. They caught the bear market, within the first 5-6% of the move.
Well, there's also one of the largest ever in terms of ratios put to call options, right? So there's a massive there's massive amounts of hedging going on as well.
I don't see it. I mean, honestly, call me stop and come whatever, but I'm just saying there's too many things so it's not just like you switch, you flick your fingers and then all of a sudden there'll be a massive thing and it changes the whole world. That is the way when you do it on a multi-dimensional basis and look at so many markets, you will actually say that there is a calibration that needs to go on. There are too many things that doesn't add up to a top in the market right now. And even in an escalation in the Iran, you could see that the market could make a new top. So it's not going to be the war in Iran, as I started out by saying, that is going to put in the market top, even though it might be what the media tells us. It is about the real economy that is rolling over. And at this point here, we got ample time. We got enough time, at least, for a blow-off top. And it's not just going to change just like that. That's not what I
I
see.
mean, you look no further than the Tel Aviv Stock Exchange, right? If you look at the last year and a half or so, it's done over 100%.
The
Yeah,
Kospi and
war
the
basically,
Bonspar and everything.
yeah, exactly. Like war is a short-term positive because of the expected fiscal stimulus that comes with it, right? Kind of there is a direct economic link there. Before we leave, guys, do we want to maybe just give concluding remarks just to kind of summarize your position for those that maybe weren't there throughout the whole conversation, or for those that would actually want to have some kind of summary out of our discussion today? Maybe starting with you, Henrik.
Yeah, sure. Yeah, well, I said it before, and I said it again. We're gonna have a very, very bad crisis. We're gonna have the worst we've ever seen, and I think I'm with Willy also on that. We have a bear market in the Bitcoin, but a bear market in Bitcoin could also. There's always a big bounce, and in Elliott wave terms, it's called a B wave, and these can be quite strong and quite convincing. So I think we're gonna see that we in these extreme risk assets, which Bitcoin is, and it's going to crash horrendously. And it's not going to be a safe haven or anything like that. We're going to see that there will be a very strong bounce as I see it. And we're going to see new all-time highs coming to the NASDAQ, to the S&P, and to the also to the small caps in the US. There's going to be a rotation into US assets. You're going to see that coming away from the European assets, and you're going to see a bounce in the European assets. But the crisis that awaits is going to be bad, and it's going to be bad for several reasons that we discussed here on these webinars. And I only see that we have even factors that can make it even worse now from what I'm looking at. So stay tuned. But again, don't get too convinced about the rally that is about to set off. Don't get too convinced.
What about you, Willy?
Yeah, I think that timing wise, we could see, a confirmation of S&P topping in the next quarter. That quarter starts in a few days. Bitcoin, middle of the bear market. I don't see it at this stage bouncing past the mid to low 80s. I think that's kind of the upper resistance that has to be contested. We'd need a lot of structural changes that are going to be bullish. They have to be bullish before we can break 85. So I think the most likely path at this point is a rejection of the low 80s, and then a breakdown of this price level. And so kind of in the middle of the bear market, we're waiting for equities to go bearish, and then we'll be confirmed in the middle of it. And then look for late this year for liquidity environment to improve. So it's just sit tight, be patient.
Yeah, I agree with that outlook in terms of Q2 being the quarter where we see the combination of tops and the onset of the actual confirmation of a bear market. I think that is very likely at this point. I see that as well. Flows are, especially the more long-term gyration in flows is definitely indicating or pointing towards that. The one thing I would add to Henrik's view is that I think Ethereum might actually be the dark horse here as well, where I don't see Bitcoin getting anywhere close to the all-time high. I think I've been consistent on that since December probably of last year, where it's just like structurally, given the flows, given the fundamentals, that wasn't the case. With Ethereum, I actually do think that there is a chance we actually see a test of the all-time highs and potential a new all-time high forming there. There's a lot of reasons for that, also structurally, given the general adoption or the front running of adoption of stablecoins, the proliferation once the actual Clarity Act, let's say, comes into full force, right? So I think there's things there that make it uniquely interesting to look at from a theme perspective. And also the fact that it's much more tied to the beta on NASDAQ, right? Which means that if we have a strong NASDAQ that is not overbearingly strong, but is strong and continuous over the next, let's say, 10 to 12 weeks, I would see that, kind of rubbing off positively on an evolution of where Ethereum goes, basically, in terms of price action. But yeah, to Henrik and Willy's point, I fully agree. What comes after over the horizon is not pretty. There is a lot of very bad things coming our way, and I do think that it is all about really learning what frameworks to use and what to trust, because I think it is not a good idea to trust one type of indicator or metric, but it's going to be a confluence of different things that you will need to be able to navigate this volatility that is coming, right? So we're going to see massive dislocations, a lot of volatility, and to something that Henrik alluded to back in November, December, in that sort of environment, I mean, you'll have the Dixie over 120, right? So it's going to be the Dixie wrecking ball 3.0 here in a big way. Yeah. So don't stand in front of the bus whenever that starts happening. Sounds good, guys. Thanks a lot for the time. Sorry for going over as well, but I think it was a good talk, and we'll probably touch base again towards the mid to end part of April, right? That's what it seems like with Easter coming up. But for those of you that want deeper information, or let's say more in-depth information on frameworks, different inputs, like Willy said, we have a Substack letter that basically called the top. And if you want deeper info, there's always Henrik's Zeberg letter, which is very, very powerful when it comes to the more structural, fundamental analysis cross assets and also US economy, which I think is very important here now. And also Hawkeye, right, for general cross asset liquidity momentum, and also Bitcoin, Ethereum, altcoin specific perspectives on how to trade and when to go risk on, risk off, right? So the kind of the cohesive kind of umbrella view on cross asset. Thanks a lot, guys, and yeah, see you next time.
Cheers.
Cheers. Bye.